What's up, everyone? Welcome back to the ETF Investor. Today, we're breaking down CNBS, the Amplify Seymour Cannabis ETF, one of the longest-running and more complex cannabis ETFs on the market. CNBS is designed to provide exposure to the U.S. cannabis and hemp ecosystem. But this is not a simple, passive marijuana ETF. It's actively managed, flexible in how it gets exposure, and comes with unique risks that investors need to understand. CNBS invests primarily in U.S.-listed companies that derive at least 50% of their revenue from cannabis or hemp-related activities. The fund categorizes the industry into three broad buckets. First are companies directly involved with the cannabis or hemp plant itself. This includes cultivation and retail operators, pharmaceutical and biotech firms developing cannabis-based treatments, hemp product manufacturers, and cannabis-infused consumer products. Second are support companies, businesses that enable the cannabis industry to operate and scale, such as agricultural technology firms, real estate providers, and commercial services. Third are ancillary businesses. These companies don't touch the plant directly, but benefit from legalization and industry growth, including consumption devices, finance and investing platforms, technology providers, media, and other indirect players. One key differentiator for CNBS is that it can use derivatives. The fund is allowed to invest up to 60% of its assets in derivative instruments, including total return swaps, to gain exposure to cannabis-related companies. This structure helps the fund navigate regulatory constraints in the U.S. cannabis market, but it also adds complexity, counterparty risk, and potential tracking differences compared to holding stocks outright. Because CNBS is actively managed, the portfolio can change meaningfully over time. The managers can shift allocations based on regulation, market conditions, and company fundamentals, which can be a benefit in a rapidly evolving industry, but it also means performance is heavily dependent on manager decisions. This is not a buy-and-forget ETF. From a risk perspective, CNBS is highly volatile. Cannabis stocks are sensitive to regulatory headlines, interest rates, capital market access, and sentiment shifts. Even with diversification across the ecosystem, drawdowns can be severe, and long periods of underperformance are possible if legalization catalysts fail to materialize. Bottom line, CNBS is a thematic, high-risk ETF built for investors who understand the cannabis industry's uncertainty and want actively managed exposure rather than a passive basket. It can make sense as a small satellite position for aggressive portfolios, but it's not suitable as a core holding. If you're investing here, position sizing and expectations matter. If this breakdown helped, hit like, subscribe to the ETF Investor, and let me know in the comments what other niche or thematic ETFs you want covered next.